All of that, we're joined by Stan Shamu from IG in Melbourne. Stan, good to see you there. Yeah, the Aussie testing that 93 level. What are you expecting from the CPI and also the China PMI data today?
Yeah, whilst consolidation was the main theme in the equity space, I think the risk currencies really outperformed yesterday, particularly the Aussie dollar, which is hanging around that 93 level against the greenback. Of course, we saw the US dollar pull back a little bit, but I think the Aussie dollar has quite a bit of momentum, particularly from the China front, where we've heard quite a number of announcements this week, particularly pertaining growth yesterday when the PM generally basically said 7% is the absolute bottom line for growth. I think they are still eyeing that 7.5% per annum growth, and that really did encourage investors to get back into this Aussie dollar. I think heading into the CPI today, we might see it a little bit sidelined around that 93 level. Of course, the number comes out at 11:30. Basically, on the quarter, we're expecting it up 0.5%, and on year, the run rate's expected at 2.5%. But the figure that the RBA actually looks at is generally the trimmed mean for the CPI, which is expected at 2.1%. So it certainly seems like if we'd come in line or better than expected, then we might see this Aussie dollar nudge through that resistance in the 93 region. But of course, if we miss estimates, then that would reaffirm the camp that we'll see a rate cut in August, and that would definitely see the Aussie dollar sold back down, and of course that 93 level would act as firm resistance. But shortly after the CPI, we also have China's HSBC manufacturing PMI number, and that's expected at 48.6. So that will probably be another source of volatility for the Aussie dollar, particularly given the fact that most of this week's gains have primarily been driven by comments out of China so far, and of course China remains a main topic for the region. So there's quite a bit to look out for the Aussie dollar today, but we just have to keep an eye on that 93 level and see if it can act as resistance and see the Aussie dollar sold off, or if we can break through it and push a bit higher in the short term.
Stan, what's your opening calls for the ASX 200?
At the moment, with the consolidation we saw in our US markets, we're calling it relatively flat at about that 5,017 level. But the fact that we closed above resistance yesterday, which is at 5,012, could be a bit positive for the local market. We are eyeing a fairly strong start for the iron ore miners, particularly BHP, which is pointing up around 1% at the moment. Of course, we also have iron ore prices pushing up about 0.2% overnight, firmly above 130 now. So that will be fairly supportive for the rest of the iron ore space. Yesterday, we had Fortescue Metals underperforming a bit after their fourth quarter output report. Overall, the report wasn't actually bad at all. It was fairly mixed, but we did see a little bit of profit taking on Fortescue yesterday. Should we see some positive broker or analyst comments today, then this should support Fortescue. We still feel that any pullbacks into the 350 region should be used or could be used as buying opportunity for Fortescue. And apart from the iron ore miners, we also have gold remaining quite strong. I think it was at 1,344 last I checked, and that should support the likes of Newcrest. It certainly looks like it might be headed to about $15 in the short term. But of course, in the longer term, we probably will still see gold names underperform as the US dollar comes back to life. So there's quite a bit to look out for in the mining space, but we might see a bit of sidelined action for the overall market until we get more clarity from the CPI number and of course China's HSBC manufacturing PMI.
What about the Japanese trade balance? What are you expecting there?
At the moment, I think the overall consensus is trade deficit of 0.52 trillion. Now that's quite an improvement from, I think, the 0.8 trillion deficit that we had the previous month. So it really looks like Japan has turned a corner. Things are looking fairly more positive than they were a year ago, and it looks like the current regime's policies are certainly starting to pay dividends for Japan. Of course, we did see the dollar-yen rally through 100 heading into US trade yesterday, but with the US dollar pulling back, we have since seen it drop back to 99.50. So that should be a little bit of a concern for the Nikkei, which is pointing down 0.4% at the moment. So it will be, I suppose, a situation where if we see this dollar-yen manage to recover off these lows, then the Nikkei call might start to push a bit higher. But of course, we still feel that any dips below 99 for the dollar yen could be used as an opportunity to accumulate. Following that upper house victory for Shinzo Abe over the weekend, we certainly feel that Japan's in a good stride at the moment. And of course, with their policies set to continue this Japan recovery, then any dips could be a good opportunity to get involved in Japanese equities and the dollar yen as well.
Stan, thank you.
Cheers,
Stan Shamu there from IG. Well, let's just remind ourselves what happened in yesterday's session on the ASX. The local market continuing its momentum, closing at a fresh 2-month high and ending up 1/3% at 5,017 points. To the performance of the different sectors, the healthcare space saw the best gains, up 0.8%, followed closely by the materials. It was a different story for the energy sector.